Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going to get into the 6 essential habits for long-term wealth building. But before we do that, as always, the free tip of the week coming at you. Know the difference between price and value. I'm going to read that one more time. Know the difference between price and value. Price is what you pay, value is what you get. Now, I'm going to tell you from an investment standpoint specifically, so many people misunderstand this concept. They look at, and I'm just going to take the stock market to make it really easy. They look at the stock market and they look at the price and they go, oh, that is dictative of if it's an expensive company or not. I have seen businesses where let's say that the stock price is $3, and I have seen other businesses where the stock price is a couple $100. And when you do the math, the couple $100 stock is infinitely cheaper and a better business than the $2 to $3 stock. But people just look on absolute terms. Understand the business and the value it provides, and eventually you will figure out what is the best price. So now that we've got that taken care of, we're going to get into the 6 essential habits for long-term wealth building. And the first one, and this is the easiest one that you need to understand, is don't overspend. So many people, and we have talked about this for years, and we're going to keep talking about it. So many people get excited in the sexiness of the quick get-rich scheme. And they think, oh, as I get rich, then I won't overspend. Like I just need to make an infinite amount more than I am right now. That is the farthest thing from the truth. And there's a lot that goes into that. Peter Lynch actually brought this up. And Peter Lynch, for those of you that are not aware, was an award-winning, he still is an award-winning investor, but he was famous for running the Fidelity Magellan Fund from 1977 to, I believe it was 1990. And over that period of time, that investment earned an average annualized return of about 29%. So if you had $100,000 with him in 1977, and in 1990 when he closed down the fund, he didn't close down the fund, he just retired. After that period of time, that $100,000 would have turned into $2.3 million. It's just insane, okay? The reason why I bring up Peter Lynch is there's a really famous speech that he gave. And what I loved about Peter was he spoke in layman's terms. And he just struck me as a guy that, like, if he was at this table right now, we could just have a conversation as a couple of guys. Like, it doesn't have to be technical, but he was brilliant. And his thing was, I'm always curious and perplexed as to why so many people are fascinated with the whole idea of getting rich quick. Like, building wealth, it is a long-term game, and people say that time after time, but they don't actually absorb it. And part of that is if you don't overspend, that's like half of the battle. Now, as far as don't overspending, that actually dovetails into the second essential tip for long-term wealth building, which is living within your means. Now, there is a difference, okay? Don't overspend. It's very black and white. Live within your means, that can be a little bit more variable. So let's say that you're netting, I'm going to make this up, okay, just for easy math. Let's say that you're netting $6,000 a month, okay? and your true monthly expenses, like you can't get around, are, let's say, $2,500 or $3,000 a month. Okay, and we're talking like taxes, rent, food, whatever the case is. So living within your means, that means that you could maybe increase your expenses by another 1,000, maybe even 1,500, and there's some wiggle room there. Now, I think living within your means becomes much more valuable when you start to increase what you are making. You get pay raises, you get bonuses, maybe you get a new job and just get a huge financial bump in your life, or you run a business and your business starts to really take off. Obviously, your means have become a little bit greater at that point, and you could easily make the argument that, hey, if I only need $3,000 a month to live off of, and instead of making $6,000, maybe I'm making 10 or 20, I really only need to spend, I can still live off of that 3. It doesn't quite work that way. I will say the more money you make, most of the time there are just costs and expenses that come along with that. Most painful one is taxes. But then let's say that you want to help out your family or your friends within reason. Living within your means is incredibly essential for building long-term wealth. But unlike don't overspend, it does get a little more gray, and you just need to be very sensitive with it. Now, the third one, and it's a perfect segue. The third essential tip for long-term wealth building: invest what's left over. So obviously, if you're just starting out, there may not be a lot left over. That is totally fine. If you've got a retirement plan through your employer and they are able to match, whether it's $1 for dollar up to 4% or 3% or 2% or 10%, whatever it is, you want to make sure, if there's any possibility, to get up to whatever that percentage is, because that's free money. Now, as you start to make more money, again, don't overspend, live within your means. Obviously, that is incredibly important. But this is going to be a psychological shift. So I would like to think that, my wife and I, okay, yes, we live within our means. We don't overspend. But I'll tell you what, as far as quote unquote month to month, we treat it as though there's not a lot of cash in our checking account at the end of every month. And you're probably thinking, well, why are you telling me that? Like you're the cap and capitalize. You're supposed to teach me how to capitalize on your finances, and you're telling me you don't have a lot of cash at the end of the month. I go, no. What we do is at the end of every month, we make sure that all of our bills are paid, and then literally anything that is left over, obviously we keep some money in your checking account just for whatever reason, we go and invest it. And a lot of people, especially millennials, a lot of my friends that I come in contact with, they love living for the experiences. And so they're spending what is left over on those experiences. In the short run, that sounds fantastic. But I can tell you what, in a decade, they are going to wish that instead of doing that, I'm not saying you don't live, but how cool would it be is if instead of doing that, say, hey, instead of spending our money and it's just, blowing in the wind, we are going to invest it in whatever long-term investment, stocks, real estate, private equity, lending, you name it. And then in 10 years, instead of struggling in figuring out how we would, quote unquote, manage to live paycheck to paycheck, our investments are paying for all of our experiences. We aren't. That's where it becomes incredibly valuable. Now, a lot of people think, oh my gosh, 10 years. Like, Chris, that's such a long time. It is and it isn't. I mean, we have a lot of listeners that are in their, age range 25 through 34. Yeah, 25, 10 years might seem like a lot. I can tell you what, once you get into like 33 or 34, yours truly, 10 years goes by like the blink of an eye. And it's one of those things where in your 30s, you start to see the separation between those that have set themselves up prudently and strategically and the right way financially, as well as just health and life, versus those that have not done that, or they've gotten away with not having to do it, and now life is finally catching up to them. So investing whatever's left over, and especially if you're younger, make that pretty aggressive and anal. Like we're talking like down to the last couple dollars. Your future self will thank you. So we're going to take a quick commercial break, and then when we come back, we're going to close out with the last 3 essential tips for long-term wealth building. Stick around. Don't go anywhere.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
Welcome back to the show. We missed you dearly. And let's just dive right in to the last 3 essential habits for long-term wealth building, with number 4 being invest in what you know. Now, we've talked about that a lot in the past, and it's worth repeating because once you start making a lot of money, it doesn't have to actually even be a lot of money. Once you're making money to the point where you can go and invest after every single month, doesn't matter if it's a lot or a little. At that point, you've got to ask yourself, okay, what am I actually investing in? You're going to laugh at me when I say this. If you can't explain to a 10-year-old in 60 seconds why you have invested in whatever is in your portfolio, you should not invest in it, period. I mean, it's crazy. I've actually talked to people and they go, and I go, why are you invested in this stock as an example? They go, well, because it keeps going up. What? Like, do you even know what the company does? They're like, no. Like, I just know the ticker symbol. That is beyond common. And it's also scary as heck because what you're doing is you're playing Russian roulette with your money. And then you also see a lot of people in this compounds where they go, okay, I need to get rich quick because let's say in your 50s or 60s, and I run into this a lot, where let's say that people have not been financially the most prudent. And so now they feel as though they need that Hail Mary, that fourth quarter play where they go for it all and it's going to be quick. That is a recipe for first-class disaster. And so a lot of people, they go, okay, well, what do you mean by invest in what you know? Like, where would I even start? Here's a really easy one. If you have a credit card, go on your statement and look over the last 90 days and look at what the top 10 most frequent things are that you've purchased. And those have come from a company. Look up the company and see if it's publicly traded. That is a great way to start because you're already comfortable with it. Dovetailing a little bit, but it's very, very pertinent. If I go on shows or if fans reach out, they'll ask me like, okay, how are you specifically investing in, or rephrasing it, what companies are in your portfolio? I get really nervous about that, especially as our brand is growing, because I don't want someone to just say, oh, I'm investing in X because Chris is investing in it. Warren Buffett is very famous of saying this. Just because I'm investing in it, that does not mean that you should invest right alongside me. Now, you can make the argument that that's a pretty good steward of money, and he's kind of the GOAT when it comes to investing. But you've also got to think about this. Berkshire Hathaway is so big that their circle or their universe of what they're able to invest in, it's so small that you know what? There might be a ton of options out there that Grandpa Warren would like to invest in, but he simply can't because Berkshire Hathaway is so massive and it just doesn't move the needle. So, investing in what you know is beyond valuable. And one more little side note, because I want to caution you with this. I'm actually a huge proponent in cloning. So if you find an investor or investors that have a fund or they're very public on how they are investing, because some people love talking about, what they have in their portfolio. What I would recommend you do is you go back to their filings and you figure out when they bought, and I'm just going to pick a company, okay? When they bought Microsoft or Clorox or whatever, okay? The reason why that's valuable, there are a million reasons why a smart investor, or anyone, frankly, would sell a stock. Maybe it was taxes. Maybe it was estate planning. Maybe it was gifting. Maybe they found another opportunity, whatever the case may be. It's infinitely more important to figure out why someone bought the company, because then you're learning what these sophisticated investors saw at that time, and then you can clone that mentality into your investment framework. So don't look at it as like, I'll just call out my buddy Robert Hagstrom. Oh, Robert bought, I'm making this up, Microsoft 10 years ago at this price. What did he see 10 years ago in 2014 that made him decide to do that? Okay, now I need to go and just keep looking at Microsoft. No. You figure out everything that he saw at that moment with Microsoft, and then you take that mentality and that mental model, and then you keep it in the back of your mind. So if you see the next company that screams to you, like screams out to you, whether it's the one that you use on your credit card statement or you see all of your friends buying all of a sudden, and you go, oh, that's where Robert's mentality came from, but it's XYZ company. Now I can go and buy it. But it always comes back to invest in what you know, and then it kind of snowballs from there. Number 5, don't overly diversify. Now, I don't want to say don't diversify. One, compliance would, come at me with a gun to my throat, and I'm not going to do that. But then also, don't diversify. Like that in and of itself is just flat out wrong. I think overly diversifying is equally, if not more, abhorrent for your net worth. I hate using Warren Buffett as an example because everyone seems to, but it's honestly just the easiest one out there. So when Berkshire Hathaway was in its formidable years, for the first, I think it was 3 decades, the majority of the portfolio had, you could argue, maybe like at sometimes 5-6 companies that took up like 80%. And we're talking billions of dollars. Now, most people would go, oh my gosh, that is absolute insanity. Why would you do that? Well, if you know the businesses, then why do you need to go elsewhere? Because you're now going elsewhere and trying to analyze something that you don't understand versus you have at the time the best idea and option at your fingertips that you do understand. And that's where you're going to earn the true return on your investment. Now, I could use the same argument with stocks. Joel Greenblatt, You Can Be a Stock Market Genius, a great book. He did some research through the University of Pennsylvania. And at UPenn, they said as long as you have 5 companies that are in totally different businesses, that's technically the optimal diversification that one needs from a stock standpoint. I can make the same argument for real estate, privately owned businesses. The one exception, actually there's a couple exceptions. If you're ever going to be lending or you're going to buy like a bond, that's where I would look to have extreme diversification, because if you are lending to a company or an entity, whatever the case may be, if that entity defaults, meaning it goes under, your money just vanishes, and that's not good. And so with having an extreme amount of diversification in those sectors, it's incredibly valuable. But if you're trying to grow your money and grow your net worth for the long haul, with long-term investments, you only need to be right a couple times. And again, you can go back to a number of our episodes where we've talked about that ad nauseum. And then the last essential habit for long-term wealth building: ignore the noise. So we mentioned earlier how people will buy stocks because their neighbor bought it, or their friend bought it, or their family member said, hey, you buy this. Why? Well, because my friend said so. I don't know if you all that are listening in or watched the movie The Big Short, which was a phenomenal movie, and it summarized the great financial crisis of 2008 perfectly. And there's this scene at a blackjack table, and I forget all of the actors there, but I remember Selena Gomez is at the blackjack table, and she's explaining what a derivative is. And a derivative is you're basically like saying, okay, there's two people at the table, and I might butcher this analogy. And let's say that I'm one of them and Selena Gomez is another, which would be wild. And I make a bet that, I'm going to hit a blackjack or whatever the case may be. Like I make a calculated bet that I'm going to win against the dealer. So a derivative then would say, let's say that my brother is behind me and Selena. And so he says, okay, I'm betting that Chris is going to win against the dealer. And then let's say that my teammate Betty is behind Ty. And she goes, I believe that Ty's going to win the bet where Chris is going to win the bet against the dealer, right? That's where derivatives start to get really, really crazy. And you're basically betting on something else happening. But unlike a business, it's kind of one removed. And so when the house of cards fell, it fell hard because there was such a degree of separation between, in this case, for the metaphor, the blackjack table and then where everyone was behind the scenes, that no one knew what the heck was going on. It was complete pandemonium. Now, that's really extreme, but that comes back to everyone was buying into the noise. And if you look at the most successful investors, not after 1 year or 2 years or even 5 years, we're talking 10 plus, you can figure out very quickly who has separated themselves from the pack, because when crap hits the fan and the tide goes out, you know who's swimming naked and you know who's fully clothed. And I will tell you, ironically, when there is the metaphorical blood in the streets when it comes to a particular investment or sector, whatever the case may be, that is where the money will be made. And if you're listening to the noise, I mean, God help you if you listen to Kramer or MSNBC where they're talking about all the BS that's going on out there, you're actually going to get killed. Actually, fun story. There's someone that created an exchange-traded fund that basically does the opposite of what Jim Cramer says, and its performance has been like astoundingly great. So you could probably look that up on Twitter or, X or somewhere online. But also when you ignore the noise and you really know what you're investing in, you can quickly see that, wait a sec, even though everyone's complaining about XYZ about the company, they're still making a lot of money. Like they're buying back a lot of the stock. They're increasing their dividend. They're expanding their business. Well, okay, people are complaining about what? Like 1/4 of earnings? That makes no sense. And then you keep buying more. So that really does it for the 6 essential habits for long-term wealth building. Let me know what you think, and let me know if you think there are more habits that you want me to discuss, whether they are true habits or habits that you think that, okay, maybe it's more of a myth. I would actually love to do an episode like that. But until next week, as always, Christopher Paniotto to the Cap and Capitalize. I'm out of here. Keep capitalizing. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher Paniotto, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial and inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Exchange-traded funds, or ETFs, are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Christopher A. Paniotu is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.